A lot of owners are starting to realize that they don't have an occupancy issue, they have a refinance issue. In the news, we see there's going to be about $2 trillion of mortgages rolling over in the next 2 years. And due to the changes in the market, occupancy, insurance rates, but most importantly, a lot of these investors, landlords, are coming from a low interest rate environment on their mortgage. And when their mortgage rolls over, they're going to be facing a much more expensive debt, much more expensive payment of that mortgage. And when they look at their numbers, they realize that their investment might not make sense anymore. The numbers just aren't panning out. And so it's very important for you, the investor today, is to look at those numbers and really understand if you were forced to replace that mortgage now, can your property survive? And if not, what planning steps you need to take to ensure that you can fix the problem before it shows up. So if your mortgage is rolling over in the next 2 years, planning needs to start today. It's very important. There's a lot of strategies available to you if you do the proper planning. One portion of the market, we're seeing investors negotiating with the bank right now, contemplating strategies such as handing the keys back, a deed in lieu of foreclosure. Or some investors are planning for a full-blown foreclosure with the lender. There are steps to take. One of the problems with those two strategies is the fact that when you get mortgage debt forgiveness, you're going to trigger a taxable event, okay? Whether it's a deed in lieu or a full-blown foreclosure. A lot of people don't realize that they're allowed to do a 1031 exchange. I know it kind of sounds counterintuitive, but you can defer the tax consequences of debt forgiveness and depreciation recapture. Now, a lot of people say, yeah, but if I had the money to replace that mortgage debt, then I wouldn't need to do a 1031 exchange. Well, fortunately, there are products out there. Delaware Statutory Trusts, commonly referred to as DSTs, some of these properties have very high loan-to-value built into the product. So what does that mean? That means I can take $1, right? Or should I say, I can take 15 cents and buy $1 of real estate. So if we expand that out to a larger number, that means for $150,000, I can buy $1 million of real estate in a 1031 exchange. Now you say, well, why is that good? Well, if you look at the tax of $1 million of debt forgiveness, depending on your state, if you get a 1099 for $1 million, what's your tax bill? $300,000? $400,000? Let alone, there's something else called depreciation recapture, which is going to push that number up higher. So by doing a 1031 exchange, you can defer the capital gains or the debt forgiveness, the tax from debt forgiveness, along with the depreciation recapture, and then replace that property for 15 cents on the dollar. So I don't know about you, but who would you like to be? The person making a 15 cents on the dollar investment, or the person paying 30 to 40 cents on the dollar of debt forgiveness? If you like this video, hit like and subscribe, and check out our other videos.